Okay. All right. Good morning, everyone. Today is Saturday, July 19th. This is Saturdays with Eddie. This is where we come together to talk about options trading, anything trading, stocks, ETFs, mutual funds. And we have all your questions answered. All right. We'll try to answer as many of your questions. If I don't know the answer, I probably have a resource or somebody in the crowd uh, knows how to answer your question. So don't be afraid. No question goes, there's no question that's dumb. The only question that's dumb is the one that you do not ask. If you don't ask it, can't help you. So go ahead and try and participate. That's the plan. So welcome everyone. I won't mention all your names, but go ahead, welcome. This is a beginner class, even though the faces I see in the crowd here have been trading for a while. This is more geared towards a beginner or somebody who's taken a break and wants to come back to trading. So we want to just give them a refresher. Maybe if they've forgotten how to get to think or swim, maybe they've lost some money, they felt shy, they felt gun shy. So I mean, it all happens to us. It happens to us all the time. So that's who that is designed for. Even though maybe a little later we'll go into some more advanced topics. I will answer some question. Any question is game. You want to ask me the difference between an iron condor and a condor, and you want to, figure out how to get out of your put ratio spread. I'm okay with that. That's all right too. But this class more for beginners, people who are trying to put that $1 in the bank, maybe win with a few zeros every week, right? 100,000, whatever your goal is. That's cool. So let's get started. I think I will first start by getting an agenda together. So the plan is it's a refresher, right? So we're going back to the basics. So let me hear what your struggles are. Is anyone struggling? I'm trying to get a starting point here. So what are your struggles? And you can talk. Oh, by the way, you can interrupt me at any time. I welcome that. So if you have a question, don't wait until the end. You'll have forgotten, or I will have forgotten what the context is. So what kind of questions do you have? Just writing them down, even though I don't answer them right away.
I'm here to start to get some baseline information as it relates to options trading. That's where my interest lies.
Okay.
I know, of course, I won't get all of that now, but
Okay.
just wanted to kind of hear the type of information that you share
Mhm.
and see if this scenario would be a good fit for me going
Got
forward.
got it. Got it. Got it. Okay. And then Carly put in the chat over there. She wants to hear about quick exits. I'm assuming that once you get into a trade, you want to get out quickly. Is that a yes? No? Maybe? Yep. Yep. So she wants to hear about quick exits. So she's talking about real day trading over there. Okay. Cool. Uh, Joanne wants to talk about entries and exits. That's fine. Exits come with entries, so we'll talk about both of those. You definitely have to have an entry, otherwise there's no exit. So, what is Jill? Jill, I can't hear you, but I can see
Good
you
mo-
trying to speak.
Can you hear me?
Now I can, yes.
Yeah, I have not been trading for a while, so I just want to get back to a routine and possibly, how to set up, um, you know, during off, when the market is closed, just so that I don't have to watch it. So
Mhm.
not so much day trading, but like swing trades,
Yep.
that I don't have to watch.
Awesome. 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 She wants a set and forget kind of deal. She wants the money to bake while she's working, or she's out at the
Yes.
hair salon, or she's out golfing, or something like that, or she's gardening.
Absolutely.
Is that about right? Yeah.
Absolutely. You hit the nail on the head.
There we go. There we go. When you're holding a hammer, everything looks like a nail. So,
Exactly.
okay, we'll try and get to that. Okay,
Thanks.
sure, sure. So, all right, let's welcome a few more people, Yvette and Morton, I guess. All right, cool. And if you have any additional questions, keep that chat rolling. So paste them in the chat. I'm going to look at it periodically just so that I keep up to date over here. Breakfast is V8 energy drink. All right, all right, all right, all right. V8. V8. Yeah, that's good too. It's good too. I think for those of you that missed the question, she's responding to what did you have for breakfast? That was the icebreaker this morning. So cool. All right, so we've got somebody who's a long-term trader here. Someone who wants to know what options trading is about. That's my best question right there. We want to talk about entries and exits. We want to set up a routine. When the market is closed, we're going to talk a little bit about swing trades. So first off, is everybody using Think or Swim? Yes, no, maybe. What are you all using? What platform are you most comfortable with?
I'm using TradeStation.
Okay, TradeStation, right? The web
Yes.
version or the desktop version?
The desktop version.
All right. So that tells me you probably have a Windows machine. Okay. And how's that working for you? Is that okay working well?
Yes, it is. And the reason why I'm not using Thinkorswim is one time I tried to use it and I was going back and forth and I was getting confused. So I was like, let me just stay with one platform. And that's why I stuck with TradeStation.
Got it. Got it. All right. TradeStation is it's a good platform. No major complaints about it. Actually, zero complaints about it. I really don't care what platform anyone uses. The fundamentals are the same. Call is always going to be a call. A put is going to be a put, and so on and so forth. It's how you implement it, how easy it gets. So I like that. Anybody else using anything other than either of those? Okay, so Jill is using Robinhood also. She's and hopefully that's a Robinhood legend. Is that right, Jill?
No, what, not that I'm not aware. I don't think
You
so. So I'm gonna say no.
no, but you do
What's
have
legend?
Robinhood, right? What is
Yeah,
legend?
but oh, okay.
Oh,
I don't. I just downloaded it recently, so I'm not
yeah,
really using it, but I have it on the
got it.
computer. You're saying
Yeah,
this is an app, so I don't know
okay.
on the phone.
All right, got it. Did you know that they had browser-based legend? No, no.
No.
Ooh.
Ooh.
Oh, yeah, we're gonna have to introduce you to that. Actually, I'm pulling it
Okay.
up as we speak. And I actually do have a Robinhood account. How about that? Let me see. I'm going to share my screen here and share sound. And somebody didn't know that either. Who was that? But lost my chat. Where's my chat? C. Morton. C. What's your first name? C. All right, we'll just call you C. How about that? All right. So can you all see my screen?
Yes.
All right. I'm looking at Thinkorswim. And I just wanted to show you my Robinhood account that I've held on to forever. And I have a whopping $5 in it. This is it. This is how it looks like. This is I think this is yeah. This is the old style. So you
Mm-hmm.
pretty much just looking at this, same thing on your phone. But if you go into Legend, and I'm going to type in Legend right there. How about that? Robinhood Legend. That is it. Yeah. Now it's starting to look like a real platform.
Okay.
And you can do your options, you can do your watch lists, positions, you can do your charting, you can change a few things. Uh, it's not too shabby. They've grown up. That's what I think. And it's all right. Lots of people have made millions of dollars using Robinhood. There's nothing wrong with that. So yeah, that's legend for you.
Okay.
And you can do a lot of the things. This is really good for beginners also who are learning options. And let's say you want to go in and I've forgotten how to do this. I think it is. Oh well, I'm gonna have to. Let's say I wanted to trade SC. Let's trade JetQ. How about that? Let's trade that. That will trade regular shares, but if I want to trade options, I think, well, I'm gonna have to think about where to do that. But I know you can do that. You can on Legend, so that's
Nice.
yeah. Cinnamon, all right, Cinnamon Morton, how you doing? Well, good to meet you. So that is that's a really awesome name right there. Good to meet you. Okay, so what are options? Let's start with that. That will take care of a few questions here about those who don't know what options are. And if you're watching me for the very first time, my name is Eddie, and I do options. That's who I am. Been trading options for a very long time. Been trading ETF stocks, mutual funds, even longer. So as far back as I can remember, maybe 20 years ago, maybe I was trading. I was doing something to do with the stock market, not just in the US, but somewhere else in the world. Options involve leverage. And by the way, yeah, and by the way, if you hear us give a stock tip or anything like that, this is I'll call this for educational purposes only. I forgot to put out the disclaimer out there that this is mostly education. It does relate uh, to the real world, and that's all right. Okay, just make sure that before you go out to your real accounts, you practice. So options involve leverage, and leverage here means that if I buy, for instance, one ETF, somebody in the crowd here says that they trade ETFs. So if you buy one ETF right now of what symbol is this? SPY. SPY is the S&P 500 ETF. It's gonna set you back around $627.58, give or take, depending on when you come in. But that's just one share. If you wanted 100 shares, then you'd have to spend roughly 62,700 and change, right? So that's capital intensive. It's very intensive. If I wanted to make $100 real quick on SPY, and I had 62,700, I'd buy 100 of them, right? Does that make sense? I'd buy 100 of them. I'd wait for SPY to move up $1. I know SPY can actually move up even $4 in a day. That's what this ATR, or average true range, means. It means that on average in the last 14 days, it's moved roughly $4 either direction. So if I wanted to make $100 on these and I have $62,758, I'd just buy 100 of them, wait for SPY price to go up $1, then sell it at 628 and change, and I would have made $100. You with me so far? Yeah. So that's very capital intensive. But what if I wanted to use leverage, which is where options comes in, and I say that I believe this. Now I'm building a thesis here. I'm building, saying that it is possible that the price of SPY, and let's look at SPY here on a chart. It is possible that the price of SPY is going to go up to say 630, 635. We are very, very close to that. In fact, we're at the all-time high. We'll talk about how to trade in an all-time high situation. So let's say my thesis is that SPY is going to continue to go upwards another few dollars, maybe $3, $4, give or take, and I want to make $100, the same $100 that I wanted to make a minute ago, but I don't have $62,750. I only have a few $100. How would I play that? The way that I would do that is that I would buy an options contract. Now, notice that my chain, and we'll talk about this also, has got some really interesting things over here. It's got a date, it's got a number in parentheses, it's got a 100 weeklies. Some of them don't have weeklies. What's all this, right? This is meant to confuse the heck out of me, but it's not. Some even have quarterlies, right? We'll talk. So let's say I'm risk averse and I want to go out maybe 20 days. I think in the next 20 days, we're going to see a few dollars up movement. So I'm going to open up these expiration, and let's say I've got $1,000 in my bank account and I'm going to buy an at the money call strike. It's going to probably cost me right about $911, $910, give or take. Are you tracking? Tracking? So options, for those who don't know about it, are leverage. And the leverage that I'm referring to is that one options contract represents this number in parentheses, 100. Now, if you're trading options all day long, all year long, this number is always going to be 100. Why do they even bother putting 100? Don't they just assume we know that? Well, it's because it hasn't always been 100. And in fact, there are some instruments where you will buy options contracts that are not necessarily one contract is representing 100. Here's an example, right? ES, one of them is actually representing 50, right? You are pushing one like MES, right? It's another options micro is probably 25, all right, as opposed to 50. But I don't think we'll talk about futures today, but you get the drill. So 100 is the multiplier that we always have to use for options, regular options. And so if I buy one call contract, and the call contract here assumes that I'm anticipating price to go up, right? What price am I talking about? I'm talking about the price of the underlying, the value of SPY, which was the 627. I am anticipating this to go upwards. And so if it goes up by a few dollars, then I'm wagering here that I'm going to spend a contract for $9.11. That is the premium. That's a premium. And that this premium is going to increase as the value of SPY increases. So am I actually going to spend $9.11? Well, no, not exactly. Remember the multiplier we talked about, the 100. So that 9.11, if I multiply that by 100, that's $911 in real money. In fact, I'm going to push confirm and send just so you can see that. Notice that I'm spending $911. So that's the cost of the trade, including commissions. That's going to be 911 plus 65 cents. That's going to be 911.65. Now, some people pay a lot less in commissions. I pay a lot less than 65 cents. You can negotiate that with your broker all the way down to like 10 cents or even 15 cents. Yeah. So it also depends on how much volume you're trading. So for new beginners, somebody new to options, this was a 40,000 foot overview. In general, a call is a strategy that you employ when you anticipate that the underlying is going to increase in price. It gives you the right, but not the obligation, to purchase whatever that underlying is at a particular strike at a future date, up until that future date. Two things happen at expiration. Either your call or your options contract is in the money or it is out of the money. If it's in the money, then it has value. If it is out of the money and you did not sell that contract, you are pretty much out of luck. So you lose that value. Because a lot of people also ask, if I just bought this 911 strike and today is August 8 and the price of SPY is now 620, what next? Do they give me back my $911? Is that a yes or a no? Or do I lose it? Or what happens? I mean, how do I even make money? What's the deal? So that question is answered by whether the price of the underlying is below or above a 627. 627 is the strike. So there's plenty of fundamentals that we're skipping over here, but definitely need to be addressed as we dive deeper into options. But we want to understand that in order to make money, we're usually building a thesis about our particular instrument. So talking about SPY here is the instrument. We're saying that if it rises, then we will make some money based on that call options contract. That's the simple case. Right, let's take it a step further. What if we believe that instead of this instrument going upwards, that it is actually going to go down, meaning that it's going to go from 627 to 625 to 20 and so on and so forth, and maybe land at about 620. So that's about a $7 movement down. Now, is that desirable? I don't know. Do you care? Maybe, maybe not. I should say not. Why? Because you can also make money while the stock price is going down. How do we do that? Yeah, it's $1 million question how we do that. So again, now instead of buying a call, remember we said we were going to invest in a call for 8 August. Instead of being on this on the calls side, I should probably bring up my fancy little pen over here. And let's see whether I can draw. Yeah, I can draw. Yes, so this was the calls side that we were talking about, right? When you think that price is going to go upwards. When we believe that price is going to go downwards, instead, we are going to go for, I'm going to change colors here a little bit. We're going to go for our put, right? So puts on the right, calls on the left. It's always going to be like that. Most platforms will respect that nomenclature, if you will, right? Calls on the left, puts on the right. Or even if that is not the case, they're going to be stacked one on top of the other. For instance, if you go into your mobile screen and it's too small, then you don't have a lot of real estate. They might stack them one on top of the other. In that case, calls will be on top, puts will be at the bottom. Right, so let's say we decide or we theorize here that the value of SPY, which is currently 627, is actually going to trend downwards. Then in that scenario, we want to maybe buy an at-the-money put that would be on the ask column. All this time, by the way, we're going to be on the ask column. So we'd spend roughly $742, the 628 strike. And then as the value of SPY goes down, then the value of this options contract will increase. So there's a little bit of inverse relationship there when it comes to puts, but for calls, it's a direct relationship. If you remember your fifth grade math, I think proportionality, when one variable, say PQ increases, when P increases, Q increases, that's a one-to-one, or that's a direct relationship. When it's the inverse, then you reverse that trend. But what strike do I pick? There's all these strikes. There's 621, there's 622, 23, 24, all, so on and so forth. In fact, if I click on this strike selection here and I click on all, then I discover that there's even more. Now it's bewildering. It's just mind-boggling. Oh, it gives you a headache, right? How do you make sense of all of these? So here's how it works. When you think that price, I'm going to start there. When you think that price is going to go upwards, so we're going to concentrate on a call, we're going to choose a call. How do we pick the strike? We're going to pick an at-the-money strike. At-the-money strike is always the one that is, at-the-money strike is always the one that is as close as possible to the current price. So if our current price is 627, then if there was a 627 call strike, that's the one that would be at the money. In order for it to be considered in the money, the strike needs to be less than the current price. So anything below 627.58 is actually in the money, right? So everything that is shaded here is in the money. So when you hear me talk about in the money, out of the money, that's what I'm referring to. Out of the money means that it is that the strike is now below, or rather greater than the current price. So everything that is greater than 627 in this scenario is out of the money. We generally do not buy out of the money calls or out of the money puts unless the strategy calls for that. And there's plenty of strategies that call for that. But in this simplest form, we always want to be at the money or slightly in the money. So clue number one, when you're choosing what strike to buy, you now know which one to buy. In terms of the expiration or the days to expire, and I should have talked about that maybe a little earlier, is these numbers that you see here that are in parentheses. I normally favor 45 to 90 days. So if I were to start these over, then I'd go over to this options chain. I'd actually collapse this and I would look for the options contract that is expiring about 45 to 90 days. So I can see here that I have a choice of August 29 or 19 September. That seems to be too far away. I think I like the 41. So 41 is pretty close to 45. So I do like that. Also, you notice that they are a little bit more expensive. So at the money contract is 1407 for the 41 days, whereas for 20 days, it is actually what $911 for the 627, or the 628 is 849. Why is that? Why do they get more expensive? The farther away from today, the surer you are, right? You have plenty of time. So in this particular instance, I've got 41 days to expiration, means that the market can go in my favor more likely than if I choose one that is 3 days away from today. 3 days, my thesis has to work exactly right. Otherwise, it will not be a winner. So notice that my chances of success here are even lower. I'll spend about $243 on the 627 strike. Question is, will this underlying actually move as many points as I anticipate in 3 days? 3 days, by the way, is on Tuesday, right? Yeah. So how much confidence can I have on that? Not so much. Whereas if I go a little further out, I give myself a better chance of success. So it's a bit more expensive, but I have a higher probability of success. Puts on the other side, same scenario. You anticipate price to be going downwards, then you employ a put, uh, and that's it. Let me pause there for questions for this. Remember, this is mostly beginning stuff. So questions on that.
I have a question. When you were at the 3 days,
Yes. You mean
and
22 July?
yes,
Okay.
okay, and say you bought, I guess, the 100, um, bought in with the 100 shares,
Mm-hmm.
and you realizing that it's not going to move by
Mm-hmm.
your expiration date. Can you
Yes.
get out on the second date?
Yes. You can get out 2 minutes after you bought that. You can get out 1 minute. You can get out 30 seconds. It does not matter. So this is a very, very liquid, basically in options and also in shares. There are some instruments that are so liquid that you can practically get in and out. I think my best record, uh, 3 seconds. It used to be 6 seconds for a very long time, but I think my new record is about 3 seconds inside of a trade and $500 profit. So that's advanced stuff. But to answer your question, if you purchase this contract and one of two things, you either realize that's not what you wanted or it has reached your profit target, you can get out at any time. No
Okay.
limit. So with shares, the difference between shares and options contracts is that with shares, if your thesis is wrong, you can hold them for a very, very long time. You are not bound by anything. But with options, they have expiration dates. That's what this number over here means. The 22 July, according to your question, which expires in 3 days, then you have until 4 p.m. 22 July to exercise anything that you want to do with that contract. You can either sell it, you can roll it, you can do something else.
Okay, so if it doesn't hit your price, like you thought it would, would you lose money, or you would keep what you put in? If you understand what I'm saying.
I think I do. So let's first understand what that maximum or what that profit loss scenario looks like. And this is important when you're going in, because you're going in as a businessman over here. You're in this for money, and you don't want to make it look like you're gambling. So you want to gauge your probability of profit here, or probability of success. Let's first understand what is the maximum possible amount of money that you can lose if you go into this. If it's a straight call or a put like we're doing here, the maximum that you can lose is how much you spend. So in that scenario of 3 days, the maximum that you would lose is $243. Okay, that's the maximum. What is the potential for making money? How much money do you think that you could make? And this is where we're going to bring in a few other additional parameters to help us. And we're going to talk about something called delta. So we want to know if I buy this contract at $2.43 and the price of the underlying, which is SPY, moves up by say $5, how much can I potentially make? That's probably going to be your next question, right? So to calculate that, I will bring in this column here called delta. And real quick, I will say delta is the rate of change of premium. Premium is how much you are spending on this particular contract. So $243 or $2.43 in premium is how much you spent. And delta is the rate of change of premium. What that basically means is that every time this underlying increases in value by $1, then the value of the premium increases not by $1, but by the value of delta, which is 0.57. So Yvette, what do you think if we bought these at 243 and SPY has increased by exactly $1, what is your contract now worth? So you got your calculator handy?
You said if we bought it at 243?
Yes, and the value of SPY has increased by $1. How much is your 243 contract now worth? So we just need to add 0.57 to it.
Okay, would that be $57?
That would be $57 how much net that you would have made at that particular point. So yes, it is $57. So your contract would now be valued at $3. You see how we're making money on this?
Okay, yes.
Yeah, so you purchased it at $2.43, and the value of the underlying, which is SPY, increased by $1, right? So it went from 627.58 and it is now worth 628.58 or 60 or something like that. It's increased by $1. So we want to know how much the thing that we bought for $2.43, is it still worth $2.43? And that answer is no. Its new value is whatever we saw that the delta was times the change. We saw 0.57 times 1. So this $2.43 is now going to be worth $3. It means that you will have made 0.57 in premium. Now, 0.57 in premium is equivalent to $57. All right, $57. I hear your ears ringing. You just found a way of making $50 real quick. Is that about right, Yvette?
Yes, I see.
Yeah, and you only spent $243, right?
Right, yes.
Yeah, as opposed to $62,758. In fact, if you wanted to make $100, you probably need to buy 2 of those contracts, and that would set you back roughly what, about $5. But instead of spending even $5, how about you just wait for SPY to move up $2? Because guess what? Every time it moves up $1, your premium increases by 57 cents. So you could make 4.57 times 2, which is about $1.14. Translate that into real money, that's $114. How quickly can that happen? All right, it's probably your next question. How quickly can that work? Well, if I go to the chart and go over to the 15-minute chart, is it possible that that could happen? Let's see whether that could happen. I'll clear my drawing set here. The size of these boxes are $1, right? So every time it moves a whole box, That's $1. So I want to see whether it can move $1 or $2. And it can actually move 2 boxes down in the same, within 30 minutes, right? Or it can stagnate. So you can see that here it's not moving up and down that much. And that's why you give yourself more time. So in 1 day or 3 days, I need to see that $3, $4, $5 movement. And that's why when I pick an options contract or the expiration date, I really need something that will give me $2, $3, but I need more time on it. And that's why we go a little further out. So if I go out 7 days, 14 days, and so on and so forth, you notice that I'm increasing my chances that it will actually move. Let me go back here to the daily. The daily here being 6 months, 1 day. You can see that now on the daily, the boxes are worth what? 10 points each. Is that right? So I have a good chance that if I project out several days in advance rather than on 1 or 2 days, I have a better chance of success. So my biggest advice at the moment is go with a lot of time on your hands. All right. Pause for
Okay.
the. Okay.
Okay, thank you.
You're welcome. So there's a lot of basics when it comes to options trading, and this this also assumes a really good knowledge of some of the other Greeks. The only Greeks that we have talked about today are just delta. We've talked about delta, and we've talked about the ask column, and we've talked about the strike. Everything here, by the way, is a Greek, right? This column here it's all Greeks, including strike. Strike is a Greek. Ask is a Greek. Bid, it's just that it's in English, right? And delta obviously is a Greek, and we have a few others here. We've got delta, theta, vega, rho. So those are the ones that are most commonly used, and gamma as well, right? All right. I'm gonna pause again for more questions here. Let's see who else is, and this is this is new stuff, but we're going back to the basics again. So if you're in the room, you're an advanced trader, that's okay. So it's nice to watch some of these things. But today I'm targeting the person who's trying to remember this stuff. Okay. Who else has questions? Anybody got questions? All right. Let me also check the chat. It's my chat box. All right. Michelle says, yes, that makes sense. One of the best. Okay. Don't remember what I was talking about there, but okay, cool. So we've seen that example there. That was for calls. The same applies to puts. Some people fear puts and never be afraid of puts. The strategy is the same. It's just the thesis has changed. Your thesis in that particular scenario for puts is that price is going downwards. So people don't know what to do. If you've just started trading options, you might know about calls because everybody starts there, right? Well, bullish, by the way, bullish here means that you anticipate price of the underlying to go up, and bearish means you anticipate price of the underlying to trend downwards. Okay, I'll go down. So when that is happening, then that's when we use puts. So price again moving 627, going down towards 600 or whatever direction that's down, but whatever the momentum is. So that you can use a put, and you will make money just the same as if you were doing a call when the price was going upwards. If you anticipate price to just kind of stagnate or consolidate or move sideways, then there is another scenario where you could sell as opposed to buy. Today, I don't want to talk about selling, but that is something that we do every single day. We sell. I am a seller of options. That's how I make a ton of money. And I do make a ton of money selling options more than I make buying options, right? But when you're beginning, you begin by buying options. That's where you start. You understand that. You understand the movement. you understand how to get direction, then you venture into selling. That would be the next step once you learn the basics of buying calls and puts. I'll pause there for questions. Why do I like puts more? Do I like puts more? No, I don't care. I am puts and calls agnostic. As a matter of fact, I'll let you know that in the last 1 year, I have not traded puts and calls as much as I have sold spreads, right? In the spectrum of risk, calls and puts have the highest spectrum of risk. They have the highest risk level, right? Highest risk level. You reduce risk when you get into spreads, whether those are debit spreads or credit spreads or iron condors or iron flies or butterflies, you're reducing spread. Anytime that you're increasing in your experience, what you're trying to do is reduce risk. That's the name of the game. You know how to make the money. You want to keep that money. So the next step after learning simple calls, simple puts would be to learn how to do spreads, and that will give you an even bigger edge. It means that you can trade a little bit bigger with less risk, a lot less risk. All right, she says, oh, sold, okay, right, yeah, talk about spreads in that scenario, Joanne.
What's up, Eddie?
Hey, what's going on, man?
What up, man? I recently started dabbling in spreads, and I understand that we haven't touched that yet.
Mhm.
But what I'm starting to realize is the instrument or the mechanism by which you trade has to match your personality, you know, in the means of can you may not have the patience to buy something that expires way out, because your emotions get up and down as the market goes up and down. So you cannot really weather the storm of buying a call option that expires a year from now or 3 months from now. What I've recently gotten into is selling put credit spreads or selling call credit spreads that expired same day,
Mhm.
specifically on XSP.
Okay.
And it has definitely opened up my eyes because when you first put on the trade, it tells you what your maximum profit is and your maximum loss is. And your maximum loss is higher than your
Mhm.
maximum profit, depending on where your strike is. And that scared me at first because I'm like, holy, if this goes against me, I have the potential to lose more
Mhm.
than what the heck I'm going to make. However, what they don't tell you is that your chances of profitability or your are way higher.
Mhm.
So there's a skewed or maybe kind of an inverse relationship between, hey, if your maximum win is lower than your maximum loss, there's a high probability that your win rate is going to be higher. So I'm starting to learn a little bit about that, man, and I would hope I maybe in some subsequent lessons of yours, I would definitely love to get into selling some spreads and put credit spreads and selling some call credit spreads, and what duration of time do you play with on stuff like that, for sure.
Got it. Got it. Got it. Okay. You're definitely correct in that scenario where the higher the risk, the higher the profit, right? The lower the risk, the lower the profit. So you play safe when it's a ship, and it's at harbor, it's a dock, it's very safe until it goes out to sea. Does it have any potential of making any traction or success? Ships are built to go out, they're not built to stay at the port. So what you're referring to here is as you advance in strategy, you want to pick the ones that have a higher probability of success. It also means that they have a higher risk. So you are correct. spreads do have a higher risk, but they also have a higher probability of success. Not necessarily higher profit, but higher probability of success. When you're selling spreads, like in your scenario of selling puts and put credit spreads and call credit spreads, essentially what you're saying is that you anticipate the price of the underlying to stay or remain at a certain spot. And I'm just going to bring up the scenario that you brought up of XSP. By the way, those that don't know what XSP is one of those that are related to SPX. And there's a reason why people go for XSP as opposed to going for SPX. One of the main reasons is that you can have a 5-point wide, for instance, you can have a 5-point wide spread on XSP, and the risk is not the same as a 5-point wide spread on SPX. Now, some real deeper discussion here, but you can hedge your risk by going for XSP as opposed to SPX. Moves a lot slower, but it moves exactly the same way as SPX. So to your point here, suddenly you want to continue selling spreads on XSP. Your question to me, do I go 0 DTE? Do I go 1 DTE? Yes, I do. I do 0 and 1 DTE all the time. In fact, I am rarely over one of those two scenarios. It's either 0 or 1. Now, why do I go 1? It's because I want to give myself 6.5 hours more than just today, right? So if my thesis does not work out in the next 2 or 3 hours, more
That's
than likely,
interesting. That's
more,
interesting. I've never heard of that. Okay.
yeah, more than likely I'm going to need that extra day. And the reason I say 2 to 3 hours, I'm going to need an extra day is because in a spread situation, if your strategy is not working in the first $49, you're looking for a lifeline. You're looking to get out. This is a very fast moving kind of strategy. My spreads typically last anywhere from 10 minutes to about 45 minutes. At 60 minutes, I'm sweating bullets and I'm trying to get out, right? So usually I will be looking to either get out or roll that trade, regardless of what that day holds. I'm not going to hang around looking to see how things play out. I don't have that patience as well. That's one of my weak points. So I might go for 1 DTE, or I might roll that spread, or I might just cut it for a loss, even though later on in the day it might work out. The reason I trade like that is because I'm probably trading big positions. So 1 or 2 contracts, I can probably just let it sit there, check on it after my golf game. I'll be all right. Anytime before 4 o'clock, I'll come back and do something with it or let it expire. When you have 25, 50, 100 contracts on the line, you cannot have that luxury. It better work. So there's like you said, it depends on the personality and your appetite here for risk and also your patience level. For me, I think patience is, like I said, my weak points, but my risk level is a little higher. I trade a few more contracts, shorter time frames or 15, 20, 30 minutes, 45 minutes, give or take. And if things are not working at that time, then I will roll that trade or close that position. Let me give you an example here. If I trade SPX 25 contracts and the price moves against me by 25 cents, right? So, John, you can do the math there. If price moves against me by 25 cents, uh, how much of a loss am I looking at?
Eddie, so I sent this link to a group. So anybody that clicks that link it's under my name. So I
Okay,
think the person talking is Avery, right?
Avery. Okay,
Yeah,
okay.
that's
Yeah.
Avery. Sorry. I thought I was Avery. Did it come up as
Oh,
Joe?
yes,
Yeah,
it is
because you
John.
clicked the link in the Telegram group that I sent. That's why.
Okay, all right. So Avery, yeah, I thought it was John, and I thought, man, that she went from uh soprano to tenor very quickly there. So right. So Avery, I mean, if I am in the negative by 25 cents on 25 contracts,
Yeah, that's
real
like 25. Wait, hold on. I was gonna say 255, but it's really 25,000, right?
It's more like $625.
Six. Okay, got you.
Yeah, so 25 contracts and each contract losing 0.25. The quick math there would be 0.25 times 2,500. That's how you do it. And you would get $625. So you can see how quickly I can go from zero or break even to negative 625 in about, in a heartbeat. So I'm very sensitive and I'm usually banking on my thesis working my way, usually within the first 1 or 2 minutes. If it's not behaving, then I'm looking to get out. I don't have time for it to dilly-dally, go test this line, blah, blah, blah. No, I need it to work. I need to work straight. You get to that level of proficiency after a while, after a long time, understanding the markets and all that. So I don't say it lightly that I win all the time, but I do win better than 70% of the time. So I do like your strategy there. And I also like that you're trading XSP to manage your risk until that time that you get comfortable with options. So thanks for that input there, Avery.
Hey, thank you for that.
Mhm. All right. Let's answer a few more questions here for quick exits and entries, and we'll come back to that here in a second. Let's talk about setting up when the market is closed. So when the market is closed, like today, and you're trying to figure out a longer terms or a strategy that will benefit you when the market opens on Monday, then you need a good watch list, right? You need good watch list. I'm speaking to Jill over here and people who might be in her situation where you just don't have enough time during the day to crack open your computer, look at the market, understand it in about 2 minutes before you have to answer that next email or whatever, right? So I I'm also in the same predicament. I have a bunch of money that I don't want to keep watching all day long. And so for that reason, I need some trades that can help me out. We've got two options here. You can either buy just the stock or the ETFs and hold it, and you want some good quality stock that goes up, good quality ETFs, and we can talk about that if you want. Uh, and they just go up, and you don't really care too much. You're not too concerned that they will go down at some point because you know eventually you hold them long enough, they will go up. That's one strategy. The other strategy is when you have options, then you really do need those longer dated expirations. Means that when you go over to your options chain, then you are looking for the expirations that are longer than even 45 days. Maybe you're talking about 90 to 180 days, so 3 to 6 months. That's boring. That's really boring. And it ties up a lot of money. Let's just give an example here. Let's say we believe that Microsoft, which is at an all-time high at the moment, so Microsoft, the highest it has ever seen is 514. Contrast that to just a couple months ago, it was at 425. Now, if you had bought something over here, it's already moved up by over 100 points. So whether you had bought shares or contracts, you'd be swimming in a pile of cash right about now. If history were to teach us a lesson or give us a hint, then we know that this is one stock that is going to continue to rise. We might see a red candle here from Friday, but I believe that over the next, maybe 1 year, this is going to continue to go up and up. So you can see that it has a really nice, strong trajectory. It's an over. I think the valuation of this is what? What's the valuation of Microsoft? Is it over $3 trillion? I think it is. It probably is. So this is a good company. They continue to innovate. They have new products coming on. Yes, they're going to get sued. Everybody who's got good success gets sued, right? They don't sue broke companies. They only sue good companies. So if it costs them a couple $1 billion to settle, that's okay. They have the bandwidth. But let's assume that this is one ticker that might continue to trend upwards. And even though you're buying at the high, if you're buying for a long term, then this is one of those that you can buy and hold. Even the options contract. Do I recommend that? No, not really. I have a better option. The better option is to actually identify a basket of stocks that are going to perform just as well and maybe even give me some protection, right? So, bear with me. So if I think about Microsoft, I also think about, let me get a better view here. I'm just going to go back to 6 months and 1 day. Right. So if I think about Amazon, Microsoft, Apple, Meta, Google, Tesla, NVIDIA, all of that, AVGO, which is Qualcomm, all those are going upwards. Those are tech stocks. And if I believe in the tech story, then I know that that is what is driving today. And I can't make up my mind. Should I own Amazon? Should I own Apple? Should I own Netflix, Tesla, and so forth? Tell you what, why don't I just own them all? Why don't I do that? How would I even do that? So this is where ETFs come in, and I might decide that I want to purchase QQQ. So QQQ is the Invesco thingamajig over here that's a basket of stocks that has got all these tech. It's heavily tech. Not just tech, but it's mostly tech that are at the top. If you look at the composition of QQQ, then that holds some good tech companies. So if the tech companies are going to continue increasing, I might decide I want to hold something long term in QQQ. So I might decide here to go even, let's see, what if I went just about a year out and I went to the 30th June 2026. So that's just 1 year out. An at-the-money contract would potentially cost me $5,800. Now, it's got a really big bid-ask spread here, 53 to 58. So I'm going to say that I'd like to spend somewhere in the middle there. Can we say 55? So if I spend, say, $55, that would be $5,500, right? $5,500, right? Yeah, 5,500. But what is my potential gain? What's my potential gain in that 1 year of QQQ? The way to gauge that is by looking at the implied volatility. And this is something you probably don't look at so often, but I can see here that the implied volatility here is plus or minus 95, meaning that I'm expecting price to move maybe $95. I can see here actually some of them have got an IV of 107. So let's average that and say that in the next 1 year, I anticipate price to trend closer to 100 points on that instrument. You with me so far? Remember, I have never seen what the high is, so I really don't know on the upward movement. So my thesis here is that 1 year from now, QQQ is going to be trending right about 665. Look at this video 1 year from now. Let's review that. So 1 year from now, we anticipate QQQ to be valued at about $665, give or take, based on the implied volatility at this moment. This could go up or down, but we think that it can do that. Now, that's a utopian situation. That's picture perfect, too good. What if we decided we're going to mitigate that and say maybe it can move 60%, maybe 50%? Let's work with 50%, right? And say that it can move up $50. So can it move up $50 in the next 6 months? I think so, right? I don't know, but I think so. How much would I stand to make? Well, what's the delta on that 561 strike? The delta on that is about 61. So I'm going to do some quick math here and say that if this buy boy moves just $50, right, then 50 times 61, I can make roughly $3,050. So to your point, if I had a portfolio large enough that it will allow me to buy one contract, then I can look on average for $3,000 every 6 months or so, right? Every 6 months or so. So if I could do about maybe 2 or 3 or even 5 of these, assuming I have $30,000 in my portfolio, and I want to buy some really good ETFs that can give me about 3,000 every 6 months, that would be equivalent to what? 3 times 5 is 15, divided by 6. That give me about $2,500 a month. Not bad, not shabby at all. So I think here for you, you'd be better off buying these longer term or longer term expirations rather than short term expirations. They will give you a better bang for your buck. You can go with 1 or 2 to start with, and as you work your confidence up, then you can do what? You can increase the position sizes or diversify. Another way that I would suggest is, instead of concentrating your portfolio in just long calls, I'd go for what I call a poor man's covered call. This is why you buy a long-term leap call and then start selling against it. Now, that grows very slowly. And there are better ways, there are more efficient ways of doing covered calls than doing that poor man's covered call, or even the cash secured calls, or cash secured puts. That is a subject of discussion for another day. But I'd love to have that with you, or anyone who's interested in talking about how can they build a portfolio for growth and for income when they don't have the time to trade every day. And that's becoming a lot of us. We're so busy. Sometimes you can do that, but you're so busy, it's a hit or miss. You want something consistent that is going to help you even as you go about your daily business. So hopefully that meets you somewhere in the middle there, Jill. Does that help at all?
Yes, a lot. Thanks.
Awesome. Yeah. Grab 20 minutes with me. Let's talk about a portfolio that would help you achieve that goal. You start out with a goal, maybe you want $3,000-4,000 a month extra, and you have a portfolio of X dollars. How will that help you? Or we can answer the question another way. I have X dollars. How much can these give me every month
Right.
or every week? Yeah. So 2 ways to answer that. But yeah, options, even though options are good, they're not for everyone. They're just one way out of a million ways that you could possibly make a bit of money or a lot of money. So I love that. Let's see, quick exits and entries. So somebody here wants to know about quick entries. Now, quick entries and exits depends on your knowledge of what? It depends on your knowledge of the market and how quickly you can identify the direction. So a quick entry here says that open the market up, or the market opens at 9:30 in the morning. You are probably looking at it from 8:30, 9 o'clock, whatever. But at 9:30, the market opens, and you've already identified the trend. You've already identified where you think the market is going to go. Means that in your back pocket, you have a crystal ball. That's not many of us. In fact, that's 0 of us. We don't have a crystal ball. So what do? You can anticipate where market is going to open. We've become very, very good at estimating where that is, especially for the S&P 500. We now have science that can tell us with almost deadly precision where it's going to open. Right? We figured that out. Check. Once that happens, then we know the direction for the next 15 to 20 minutes. Right? Again, check. We figured it out. So what I'm saying is that I am teaching people how to identify where the market is going to open, what it's probably going to do. That's the part that's half a check. What's probably going to do in the next 15 to 30 minutes. So if I need an entry that is going to last about 10 minutes, I need that information. And of course, she's not longer in there. She's dropped off. Did she drop off? The person I'm answering, whose question I'm answering, is actually dropped off. No, she's still there. Cully, you're there. All right. So you need additional knowledge for entries and exit. But that is that's a good case or best case scenario. We still need another scenario for how do you get in and how do you get out at will. And this is where the bracket order comes in. There are several types of bracket orders, by the way. So, for instance, if I decided that I would like to enter a trade on SPY for 9 days, July 29, and I'm going to, here's what let me propose something here, right? Let's anticipate that the 28 July expiration, 9 days from today, is going to give us some really good money. And for that reason, I'm actually going to not buy that. I'm going to, is that right? Yes, I'm going to buy a call, the 627 expiration strike, and I'm going to buy 10 of these. How about that? Right? I'm going to buy 10 of these. And I need to collect about 20% profit on the first 5 and maybe 30 on the next 3 and 50% on the next, no, on the remaining, right? So we're going to make this into an advanced order. So here's what I would do. The first thing I would do is change this from a fast single order, and I would say, tell you what, let's go ahead and pick the fast triggers fast triggers 3. How about that? Let's do that. Fast triggers 3. I don't think I've taught the fast triggers 3 before. I have taught the fast triggers OCO, which is just 1. So there should be exactly 7 orders in fast triggers 3. That's what it tells us. I'm going to make that happen here real quick. So I'm going to create an opposite order. I'm going to do another opposite order. I'm going to do another. Oh, no, actually, no. Messed that one up. Let me start over. I'm going to do this. Fast orders 3. I'm going to make a opposite. I'm going to make a duplicate, 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 right? So far, so good. Yeah. Okay, so 1, 2, 3, 4. I'll make this one a stop. How about that? All right, let's see how this is going to work. There should be 7 orders. Okay, so I'm going to need a duplicate of this and a duplicate of that. Nice. Okay, so this is a complicated order, but here's what I'm going to do. I'm going to make these 10 to get in. I am going to take profit on about 5 of them, and I'm going to do this on the trigger, and I'm going to try and make, I don't know, what am I going to try and make here? I'm going to try and make $3 on that. Okay, and then on the next, and this is 5. Actually, yeah, 5. I'm going to push these on a trigger, and I'm going to see this as -2. I'll explain this in a second. All right, I am going to sell 3 of these. I'm going to sell these on a trigger, and I'm looking for a little bit more money over on this one. I'm going to look for $4. And of course, I'm going to protect these ones, -3. And market here, I'm going to say here minus, oh, first need to make this a trigger. And we're going to also go with a -2. So notice I'm being a little conservative here, all right? And then the remaining ones, what's 5, 3? This would be 2, right? I'm gonna get a lot of questions in this particular trade here. And on this one, I'm also going to push these on a trigger. I'm going to try and make $5 on this guy. And the remaining 2, and I'm going to stop myself out here again on 2. So -2. Now, raise your hand if you've seen a trade like this one. There's my chat. All right. Or comment yes. Or comment nope or wow. So either one of those. All right. Okay. So this is a fast triggers 3 OCO. All right. What am I saying here? I am trying to buy 10 contracts of this instrument called SPY or SPY for $4.68. And I am telling the system that the first 5 or any 5, as soon as the price reaches $3, go ahead and dump them, right? Take profit on 3 of them. On the next 3, take profit at 4. On the next 2, take profit at 5. Notice that here I'm being very, very bullish. I'm being very, very bullish on my trade. And for each of these, I have a stop, right? And my stop is always 2. So I'm saying on the whole thing, if price goes down by $2, yeah, my strategy not working too well. Yeah. So I am saying that I'm trying to make 3 times 3, which is no 3 times 5, which is $1,500 on the first 5. I am trying to make 4 times 3 or $1,200 on the next 3, and I'm trying to make $1,000 on the remaining 2. So this is a really nice setup. My initial cost here is $4,068 because I'm spending $10. So confirm and send. Let's see what this does for us. All right. Told you guys I had something special for you. So I've got 7 orders over here, and you're wondering how all of that happened. My maximum loss is $4,680, but because I have a stop loss of 2,000, then I'm bringing down my max loss here to about $2,000. Yeah, 2,000. And I could make these a stop limit instead of just a limit. That makes it a little bit more complicated. But how about that? So here is a quick entry. So that's 1 entry and potentially 6 exits, right? Or 3 potential additional exits. Best case scenario, I've got 3 exits to make money. And this is on a trade. So instead of, how would we use this? Instead of getting into the position 3 or 4 times, how about I just get into it? If I'm really bullish on this particular instrument, then instead of entering 3 separate times, then just enter one, but take profit at different times. Joan or Avery is asking stop limit versus limit. Yes. So you can do a stop limited versus a stop. The difference between those two is that with the stop, I get the market price, whatever the market is trading at. With the stop limit, I tell it, right? I tell it what my limit is. Even when it gets stopped out, then I will, I get to define that. I take a bit more control. We'll talk. We can talk about that later on, but for now, it's just a stop. Let's see who has this question there. Kali, what do you think so far? Is this this might be a good entry? This might be a quick exit. I mean, what do you think? What does anybody think?
That's a little complicated for me, but I can work on it.
All right, all right, all right. Okay. Yeah. So that's exactly what that is. Go ahead.
My issue is I usually like to do by the close. And by the time when the market opens and I'm trying to get out, I usually miss all my money or most of it, some of it. And that
So,
was the
but
big issue.
buy to close, meaning that you already had something open, right?
Right.
Usually a credit spread.
No, I mean this is just on usually I buy a call before the market close. If it's ending in say for instance, if my stock is closing in demand, I'll usually buy maybe 3 calls and then the next morning wait for it to run up, and if it hasn't already run up, and then I get out before it runs back down. And sometimes I lose most of my profit
I see, I
before I
see.
can
But
get out quick enough.
now your quick exit here is starting to make sense. So
Mhm.
when do you put in your closing order? When you see the market changing, or at the time that you need to close, or shortly after you put in your opening order?
I put in my opening order the day before close, and the
Mhm.
next morning I'm trying to get out before my profit runs back down. I'm trying
Got it.
to catch the run up in the morning and get out before I lose it all. But I just can't. I've tried. I've been watching these videos for years, but still I cannot get. For some reason, I just can't get my exit to turn out right. I don't know
Got
why.
got it.
It's
Got it.
me.
Got it. So the market opens at 9:30. Nothing can happen before 9:30
Right.
unless you have a different broker that allows 24-hour trading.
Hmm.
So if you wanted that, they are available, right?
Yes. Okay.
Good example is Interactive Brokers. You can trade options, or you can trade a lot of stuff overnight before the
Hmm.
market opens. So there's that. Here in the US, it's still under regulation, but if you're outside of the US, you can probably do that. In fact, yes, you can do that. But now that
Okay.
you're in the US, so we'll just abide by the US rules, you can't do it. So you have to wait until 9:30. It means that the kind of trades that you're doing are based on high volatility. So you
Hmm.
need to be getting your direction a bit more right so that when you're trying to get out, your thesis is still good. But it sounds like your thesis is kind of capsizing overnight. And so in the morning when the market opens, you're like dead in the water. Is that about right?
Mm, um, okay.
Uh,
I'm expecting when I open up in the morning at 9:30,
mhm.
I am looking to take profit. Sometimes it hasn't gotten where I want it to go, and then I wait till it gets there. But if I'm not quick enough, then I'm gonna lose it all. I'm trying to figure out how I can get out before
Uh, oh,
I need to put in the
okay.
order before I lose my profit.
Got you.
Because
I
when
think
I buy the clothes, I'm expecting to shoot up in the, be higher in the morning when I open,
yes.
when at 9:30. So at 9:30, sometime I might have to wait maybe 2 or 3 minutes for it to run up. But by the time it runs up, I'm trying to get out and I can't make it out.
Okay. All right. So it tells me that you don't have an order to exit. You're waiting for
Right.
price action to happen before you put in your order. Is that about right?
Yes, before I put in
Okay.
my exit,
All right.
I'm waiting for,
Okay.
yeah.
Uh, that is that's dangerous trading. So you can get out with a market order.
Okay.
So a market order will give you any kind of price that is available in the market, not necessarily what you want, but it is something that will give you that will take you out immediately without the limit. The
Okay.
other options that you have is to have a bracket order with a limit that says, I really need this profit. I'm targeting 50 cents, 70 cents, whatever the case may be. You have a defined target profit and you've already put it in the system so that when that price hits internally, your order gets executed and you're home dry.
Okay.
Okay, that's actually the preferred way, right?
Okay.
There's a third way, and this one I don't recommend too much, but it is another way that you could use intraday, which is you could use a trailing stop.
Okay.
So you can use a trailing stop, and I can demonstrate what a trailing stop here is. Let me go. I think I saved this order. Yes. So a trailing stop here would look like this. So let's say I'm going to go over here to the, you know what? Do I need this? I'm just going to go to July just so that we have uh, a different order here, and I'm going to buy. I'm going to start off with a buy custom over here with a stop limit, right?
Okay.
So buy with the stop limit and say you said you had 3 contracts. Is that what you said?
Yes.
Give or take. This is just an example. So
Mhm.
you're taking profit here. You have to tell it where to stop. So I like to say that instead of using a finite number here, like 4.92 and so on and so forth, I'm going to break this link over here that turns this into a trigger function. And I'm going to
Okay.
say that I am going to set a trailing stop for minus 1. Here's how this works. The way that this works is that whatever price that you get in, let's say you get in at $5.92, then the system will set a stop limit for you at -1, meaning at 492 immediately that you get in. And as the price goes up, let's say the price is now $7, your stop would be $6. Price is now $8, your stop would be $8. So it's always $1 below. And the system automatically changes your stop limit every 10 to 20 cents. So you don't have to go in and punch in or adjust your stop loss every so often, right? The system will do that for you. So that's what that's called. That's called a stop limit. Okay.
All right.
So I would try one of those two options, either a stop limit or a bracket order to take profit at a defined movement. Now you know how to calculate expected profit using expected movement. So that's a better and more scientific way to do your trades rather than sit there and watch them and hope that it does what you want it to do, and then you are fast enough to do exactly what you need to do. I think that's you're adding the human element there and giving yourself too much credit to be able to be fast enough. I don't know anyone that's fast enough to do that. Yeah. Yeah. So yeah, try this one. I don't do a lot of stop limits. The only time that I like to do stop limits is when I'm working with SPX and I'm doing a call or a put and the market is moving crazy, like here, right? So on this particular day, I was about to fire someone. Then I changed my mind. Then I changed my mind. Then I changed my mind about firing them, and then the market went up. Right. So on a day like that one, I might employ a trailing stop because I know, the joke's on me. Usually, right? Yeah, joke's on me. I'm about to raise some tariffs, some rates somewhere, and then by mid-afternoon I've forgotten about it and said, well, what? Did I just say that? Or or I don't want some files about me released, whatever the case may be. But anyway, you get the picture.
Yes.
You get the picture. So that's when I would use a trailing stop. It's rare. You'd have to be sitting in front of your computer, understanding what's going on, and it's a bad way to trade.
Yeah.
Yeah. So use your bracket orders to target your profit. Learn how to calculate your expected profit and expected. That's like trading 101. So hit me up on a class. Let's do that. Yeah.
Okay.
Okay. Even if it's just one class, you don't have to take all 8 sessions of my class to get that concept. One class is good enough.
Thank you so much. That's a big help.
Awesome. Let's see what other quick questions. Do you mind doing an example of SPX 5 contracts below $100? Give me some more context. Do I mind doing an example for SPX 5 contracts? What do I want to do here? I want to make $100. Is that what I want to do? Help me answer that question. Okay, you want to buy 5 and you want to make hey, get on the horn. Let's talk it out. Let's hear it. You want
So basically out the money contracts, right?
out of money.
Yeah.
And you want to make 50 cents on SPX.
No, like let's say it costs 50 cents each. So like 5 of them will be 250.
Okay.
And then I want to enter and exit like what you just did with the OCO thing.
And this will be 0 DTE, 1 DTE?
One day.
Or 1 day. So on 21 July, 1 day was actually going to be 22 July, right?
Yes.
And you want to buy something out of the money costing you 50 cents.
So let's say the 41 cents.
You
right?
want the 41 cents.
Yeah, 5 of them.
This is 41 Delta.
So yeah, something really like cheap.
Something really cheap out of the
Well,
money.
if it's 0 DTE, it's gonna be like 50 cents. Because sometimes I try to take advantage of like end of day
Mm-hmm.
volatility.
Yeah.
So
Here's
let's
my
try 0 DTE.
all
That
right.
would
So
work.
0 DTE, and you want to
Yeah.
buy something out of the money,
Yeah.
and you want to buy it real.
Like a get in, get out kind of thing.
Okay. I'll give you my straight up advice. You ready?
Don't do it.
There you go. Don't do it.
Yeah.
Yeah, don't do it. That is that's telling the market maker, here's my money, take it, do whatever you want with it. It's yours. I
Okay.
don't need it. That's a bad way to trade. That's trading without a plan. That's desperate. Yeah.
Okay.
Let me give you more hope. There are easier ways if you are willing to spend a little bit more money and a bit more patience. Then there's an easier way to make $50 and not on 0 DTE, because
Okay.
this SPX is really nice. It gives people a lot of money, makes people millionaires and all of that, but it's not for the faint of heart. So if you don't know how to trade in a way that can give you $50 to $100 without using SPX, then don't do SPX. Instead, go for another instrument that will give you just as much of a return, but it's going to take a little longer. But I'm guessing here that your temperament is that you want in and out.
Yeah, like a day trade kind of thing, you know.
Okay. Yeah. All right. So a day trade to make $50 is
I mean, it
probably
doesn't really have to be XPX.
Mhm. Understood. Well, I'll stay with SPX because I know SPX a lot. Now, if I wanted to make 50 to $100 on SPX safely without burning my account, then I would sell a spread.
Okay.
Okay, I'd sell a spread. So let's do an example here. Let's say today is Monday morning, and pick a direction, up or down, doesn't matter. It's going to be wrong.
Down.
Down. All right. You know why I said it's going to be wrong? Because if I call it, it's going to be wrong, right?
I see.
Anytime I say it loudly, the market wants to prove me wrong. So let's say price you think that it's going to go down. We are presently at 62.96. We're pulling back. We're at all-time highs. What if I proposed to you that if you sold the 63.20 and bought the 63.30, you'd make a little bit of money, right? So I'd go to the options chain. I'd go to what is that? So 0 DT would be 21 July, and I would sell the 63. What did I say? 20?
Mm-hmm.
I say 63.20. Okay, so 63.20 is what I'm going to sell. So I'm going to sell it for $4 and I'm going to buy the 63.30. So it's going to be a 10-point wide spread. So here we go. And I'm going to spend about, or rather, I'm going to receive $1.85. I am selling the 63.20 call. I'm buying the 63.30 call for credit of $1.85. My risk here is $1,000. That's how much I need because this is a 10-point wide spread. And like the other Joanne was saying, is that it's a lopsided risk reward profile. Here,
Yes.
your,
Yes.
your profit potential is very, very small compared to what you could potentially lose. Because in this scenario, guess what? I am in the hole for a max loss of 815, but yet I'm looking for 185. In fact, the only way that I can get 185 is if this bad boy expires below 62.30. That even worsens my chances. But I have a pretty good chance of making money on this particular trade as long as price remains below what? As long as price remains below, what was that, 63.20? 63.20. So just going to say over here, -1, that is my short strike. Okay. -1. As long as price remains below 63.20, actually, I might even go a little higher than that. But if, according to your thesis, the price trends downwards, then I can make $50 if I sell to close, sell to open at 185 and I buy to close at what? So what's 185 minus 50? Would be $1.35.
Yes, $1.35.
$1.35. I'm gonna make this guy a one fast triggers OCO, not a fast triggers 3, but fast triggers OCO. There are different use cases, and I have a class that talks about the blast all, the trigger sequence, triggers all of that good stuff. Right now, I just want the fast triggers OCO. I'm going to right click on this guy, create the opposite order, and I'm going to push here $1.35. There we go. Right. So what's my thesis here? My thesis is that price is going to remain below 63.20, which is my short strike, and that it will decay roughly 50 cents. I will buy to close at $1.35. I tell you what I'll do. I'll actually go with $1.30 so that once they remove their costs and everything, I will be left with a full 50 cents. Is that making sense on that?
Yes.
Yeah. Yeah. So buy it back at $1.30 and keep $50 in my pocket. What are the probability of success for these? I think it's very, very high. Yeah. So with this kind of example here, I can make $50 roughly within the first like 30 minutes or 40 minutes.
Okay.
Yeah. But the risk is quite high. So I do need a stop loss, right? So my stop loss is going to be equivalent to this one. I'm going to make a duplicate, do a stop, and I'm going to say that if price goes to maybe $2.15, then that's my stop. So if that particular scenario happens, then I will have lost how much? 215 minus 185 is what? Let's do this math.
30.3.
Yeah, okay. By 0.3. So I either make $50 or I lose $30, one of the two. Either way, it wouldn't burn a hole in my account.
Oh, I see.
Yeah.
I've never done this before.
Well, there you are.
I like your thought process there. Because I never have a order
Stop
set
loss.
up to get me out of the trade. I normally am just letting it expire at the end of the day and just collecting the premium. But there's a mechanism here to have a stop loss. What I didn't catch was your math at picking a stop, or your reasoning for how much I'm willing to give this thing some room to breathe before I call it quits.
Yeah. So there's a science for that as well that I won't say perfected, but I've worked on over the years. And my stop loss will usually be a formula. That formula is 2 times the amount of premium that I received, but no more than half the width of the spread. So in this particular scenario, 2 times of 1.85 would be what? Times 2, that would be 370.
Yes, 370.
370, but my stop loss cannot be more than 5 years, because 5 is half the width of the spread. The width of the spread in this scenario is 10 points, so half of that would be 5. So potentially I could put in my stop loss here at $3.70. What would that equate to? It means that if my stop loss triggered, I will have lost, right? First, I will have given back the $1.85 that I received, and then I will spend another $1.85 for a total of $3.70
Yeah,
to close the trade. And so my net loss will be 185.
got you.
So I'm being a disciplined trader, saying here that this is a high probability trade, but I'm not willing to lose more than I could possibly make. And that's one of my rules. Don't risk more than you can possibly make. If you're anticipating to make $500, don't be in the business of losing 600.
Mm.
Okay, don't be in the business of losing 700. No, that's backwards. That's so 1970. No, you want to make $500. That's how much you think the trade should be making you. Then put your stop loss below that profit. So this is a good way to say, I was expecting to make 50 cents. I really shouldn't be losing even $1. And that's why I actually went with what? $2.15, because guess what? 30 cents in the wrong direction is a very big move. Yeah, 30 cents in the wrong direction is a very big move. First and foremost, this spread is out of the money. It is a 14 delta. So for it to increase by 30 cents, SPX is definitely going the wrong way. You don't need to be messing with it. Once you understand SPX, these small movements or these large movements, you get to understand them, that you don't sit over there twiddling your thumbs waiting for it to come back. Bad idea. So we've learned this thing. I don't want to say we've mastered, but we're pretty good at it, at identifying the trends on SPX and so on and so forth. One last question before we get out of here. What's that one? Who's got that last question? Let me first make sure.
Man.
Long-term trading, options trading, quick exits, setting up a routine. I think I've hit all the questions. And before I give you guys the opportunity to ask one last question, I teach this stuff on a regular basis every week. This is what I do at Options with Eddie. I teach you how to be consistent, how to be disciplined, how to make the money. And I have a whole boot camp about it. Let me see if I can bring up that.
Yeah, Eddie. I was shared this information just like Joan said, it was in a community chat. So this is my first time learning what you hear. How can someone gain more information about the I guess the courses you are teaching or the past lectures you've given? Like, what is the avenue as to how someone can get more training for? Oh, I see you got the schedule up here. Okay.
Yes. Yeah. Perfect question there. Optionswitheddie.com is where you need to go /bootcamp. Let me see. I would like to join the bootcamp. Yeah. So you can go to this link, starting off with Options with Eddie, or just typing in optionswitheddie.com/bootcamp. This is what we are going to do in this bootcamp, and it's a 8 session. We can either do it in 8 live, that's 2 times a week, or 1 time a week, just depending on where you are. What you will learn is exactly what I talked about: how to use options to reach your profits faster, and so on and so forth. This is a curriculum of what each session looks like, and this is not necessarily set in stone, but I try to follow these a lot, especially if you're starting off new. Then you definitely want to go through this step by step, and so on and so forth. The most interesting one that I like is session 8, which is the risk management or hedging the portfolio, and the path to 3 million. We're no longer looking for just 1 million. We've hit 1 million so many times over. Now 3 million is the new black, right? That's what I want my students to get to. But first, you have to
hit
start.
1 million so many times?
Yeah, 1 million is, anybody can hit 1 million these days, right?
That's great.
I think so. I know so. So 3 million is the new black. Yeah, if you hit 1 million, yeah, you're okay, right? You're still in the top 10% of Americans with actual investable 1 million. But once you get to the 3 million, you're kind of more comfortable. You're probably even a little older and or younger, depending. But 3 million is the new black. We'll stop talking about 1 million here pretty quickly. So that's where we
I like
want to
that.
get. That's where we want to get. So you can read about the outcomes, what you're going to learn. If you're using TradeStation, we'll probably move you over to Think or Swim or Tasty Trade, one of those. We're going to perfect how to read and understand your charts. We are even going to talk about some things that we never talk about, like a few indicators. There are a few indicators that I like, even though I haven't traditionally taught indicators, because they are historical in nature. But I do like the student to be able to read a chart and understand what's going on, what's their next move, where have we been, where we're going. We have, I will teach you some advanced strategies like condors, stratos, strangles, butterflies, and that kind of thing. This is when you're so smooth, slow is smooth, smooth is fast, right? This is when you become so smooth that you want some more excitement, like Avery. Avery likes excitement, I can tell. So you want to be smooth like him, where you're trading a little faster, a little bigger, a little safer. We'll get you to that. And then if you just don't have time, we'll go into the longer term spreads, right? When I say you don't have time, what I'm referring to is you have a profession. Let's say you're in the health industry, like you're a doctor, you're a nurse or something like that, and you just can't look at your computer all day long, no, or even an hour. So there you go. And thank you, Deborah, for that. Thank you. Right, Deborah says she is a lifetime student. Thank you. Miles has their hand up. Talk to me, Miles.
Thank you, Eddie. In terms of the boot camp, do you start these like once a month at regular intervals, or when's the next boot camp? When are the next
Usually,
couple of boot camps?
yeah, usually every couple weeks, and I try to limit the students to 10 per class. Sometimes it's just one person in the class, right? And once you sign up, then you and I get to talk. What's your schedule like? I like to teach right on Wednesdays and Mondays and Wednesdays. Those are my designated days, but I'm flexible. If you are a newer student or less experienced, I will advise once a week. If you're more experienced and you're just trying to brush up and get to speed and skip a lot of these section 1 all the way to maybe section 3, and you just want to start at 4 and 8 and a few more things, or you just have a bunch of money that you want to propel to 3 million, then I would suggest that twice a week that will help you, right? Most students will fall somewhere in between those two types. So whenever you're ready, talk to me. By the way, if you want to talk to me, the best way to talk to me is push this quick meeting link over here. It's going to ask you to select a time to meet with me, and just pick a time, and we'll make it happen.
Thank you.
All right. So it's 2 months or for once a month. No, it's 8 sessions. It's either 1 time a week or 2 times a week for a total of 8 sessions. Now that's the base. It doesn't mean that we're only going to meet 8 times and that's it. No, more than likely, it's going to be about 10 sessions, 9 or 10 sessions.
Yes, I was struggling to get the URL just right there. Would you mind copying and pasting the URL right in the chat for me?
I do not mind. I will do it just for you. How about that? So there you go. Okay. Options with Eddie. All right. One last question over here before we get out. Who's got the last question? Yep. Or maybe Miles had the last question. Very cool. All right, guys. It's been real. Let me go and turn off my video here, or turn off the sharing. That way I can see your faces. Once again, today was geared mostly for those people trying to get back in, or just trying to understand, what options are all about. It's a lot deeper than I can do it in 1 hour. It's a very deep kind of trading or kind of occupation, or yeah, that's what it is. Yeah, it's very deep. So you need more time than just 1 hour to get back in. Do I have a payment plan? No, I do not. You can use your credit card though, and that will give you a sort of payment plan, because I guess you'll be paying your credit card. It is a little bit more expensive when you use a credit card, because PayPal will charge us $250, and I will immediately push that cost to you. So whatever the cost is, plus $250 if you use a credit card. That's as close as I can get to a payment plan. Otherwise, people will normally pay by Zelle or Cash App or something like that. Okay. Let's see. Anything else here for the good?
Remind me, Eddie, the link you mentioned if you wanted to get a hold of you. You said there was something you could press if you want to just have a quick chat before booking the boot camp.
Yes. So once you go to that page that I shared, and I'll bring it
Yes.
back up over here, notice at the top there are two links. There's a quick meeting and there's a pricing and sign up. Let me first go over
Okay.
the quick meeting. You just push quick meeting. It just gives you my calendar that you just book a time and
Now I
for
don't see that. Does the website render differently on a PC? Because the options I see at the top are format, learn, outcome, schedule, summary, and best practices.
okay, so that tells me that you're more than likely on the mobile version. So
Okay.
yeah, so you're probably seeing something like this, right? Look at my screen.
Yes. Here, let me come back to it. Yes, that's
Yep.
what I see. Yep.
Okay, so go ahead and push that hamburger menu at the top
Yeah.
right. Yep. And
Okay.
once you push that hamburger menu, then
There we
uh
go.
yep. So that's it.
All right.
So that tells me that you're probably on a tablet or something that
Correct.
has a
Correct.
really okay. Now for pricing and sign up, I'm surprised nobody has asked. Uh, this is how you sign up. So all I need is just your name, email, and phone. Pretty much that's it. And then the program, it's either you want to select the options with Eddie Bootcamp. It says 4 weeks here, but we can tailor it to either 8 weeks or 4 weeks. Okay, and then that's the pricing over here. If you just want a one-time consultation, that's really very specific. That's for, you're in trouble, you're trying to get out of a trade, or you have a really strange, not strange, but you have a very specific strategy you want to discuss with me or something. Then that's when you want the consultation. All right. The quick meeting is free. Consultations are not. And then the agreement, obviously, you're just going to read all of that. And when you push continue, it's going to give you a PDF to download. That's the one that you print, sign, and send. And the payment instructions are on there as well.
And Eddie,
Yes.
if now remind me, because this is my first meeting with you, right?
Yes, ma'am.
What what has been your progression as a teacher
Mhm.
and as a trader that we should believe in confidence that you can help someone, grow an account? Have you been successful in helping folks
Both.
become
Yes.
profitable and hit, maybe 1.5 or 2 M in profits? Why should I believe in your coaching style as
In
a
my
as a
coaching.
viable option?
First and foremost, I can see several people here on this forum that have taken my class, that have known me for upwards of 3-4 years. I have taught well over 5,000 students. All right. Well over 5,000 students. I personally have been trading over 15 years. I trade inside of a 7-figure account, and I built that using options. I've lost a ton of money. I've made a ton of money, both. Now I'm in the business of keeping money rather than losing it. If anybody is in the chat that I think Deborah, yeah, Deborah, he's a lifetime student. How long have we been teaching this and known you, Deborah? Deborah's
Hmm,
one of them.
I'm, I've been a student for years, I think.
Yeah. Hmm.
I
Yeah, it's
don't
been a
even
long time. It's
remember.
been a long time. Yes.
Yeah,
So,
yeah.
uh,
And I absolutely got my money back. So, I mean, great returns. I mean, I
uh,
always tapping in because, yeah, he knows his subject. Yeah.
yeah. There's your this one testimony is right there for you, Every.
Thank you
So
for that.
yeah, and there's others. They may or may not speak out. But I have been very successful. Uh, I would say that I am as successful as my students. My goal is to help you have or make a consistent income, whether it's weekly or monthly. Definitely make your money back, because $3,500 investment is a lot of money, but it's money that I know that you can make back within a month or even before the course is over. Right? I've
Eddie,
seen
I can speak. I can
yeah,
speak for Eddie. I've been Eddie has taught me options from way back to 2021. And I've been following him ever since. I didn't join the class, but for his videos and following him, I've been right there, because if it wasn't for him, I would have never known how to do options. And I do pretty good. I do pretty well. I don't do spreads, but I do just single options. That's my thing, in and out. So I do swing and I just do scalping and stuff like that. But I do very well, and it's thanks to Eddie.
awesome. Thanks for that, Carly. And yeah, I remember Carly back from 2021 or 22, back in one of those other schools.
Yep.
And in that particular school, I believe I taught well over, I don't know, maybe 5,000 students, 6,000, I don't know, give or take. So
Thank you for that.
mhm. Yeah, this is all I do. And I'm proud of it. So I like it. All right. That, I think, was the last question. Thanks everybody for showing up. Thanks for joining me here at Saturdays with Eddie. It used to be very regular, but we took a hiatus due to travel and stuff like that. And Cinnamon says she met me through another school as well. Yes, another school. So there we go. If you need to get in hold of me, there's that link that I put out there. Push meet with me or something like that, or just send me an email, info@optionswitheddie.com, and I'll be happy to get back with you. Thanks for watching. Bye-bye.